Your bank operates differently than most people realize. I want you to understand this before I explain what is currently happening. The money you deposited into your checking account, your savings account, your certificate of deposit, the bank operates with it differently than you might expect. They utilize it for lending, they invest portions of it, they use it to generate returns for their shareholders. What they maintain on hand represents a fraction, a small fraction. And what is currently happening in the banking system deserves attention from every American with a bank account. I am going to walk you through the 4 layers of considerations affecting your money right now. Then I am going to show you the 3 approaches I am personally taking with my own finances to stay informed. And at the end, I am going to show you something most financial advisors rarely discuss: how to structure your accounts to maximize FDIC coverage. Stay until the end because that information alone could potentially protect you hundreds of thousands of dollars if challenges arise at the wrong time. Let us start with the foundation because most people have never been told how their bank actually operates. Layer 1. Fractional reserve banking. When you walk into your bank and deposit $100, you probably assume that $100 goes into a vault somewhere with your name on it, that the bank is storing your money for safekeeping, that when you come back next week or next month or next year, your $100 will be sitting right where you left it. That is not what typically happens. Not even close. Under the fractional reserve banking system, your bank is legally permitted to lend out the vast majority of your deposit the moment you hand it over. They might keep $3, they might keep $10. The rest typically becomes available as mortgage loans, auto loans, business loans, and investments. Your $100 becomes someone else's mortgage payment. And when that person deposits the payment into their bank, that bank lends out most of it again, and so on and so on. This is called the money multiplier effect. Your original $100 deposit can facilitate $800 or $900 worth of loans across the banking system. The banks earn on the interest from every single one of those loans. You receive a fraction of a percent in your savings account. They receive the spread on everything else. Now, this system has been in place for centuries and it operates smoothly under one condition. That condition is confidence. As long as depositors believe their money is secure, as long as no one becomes concerned, as long as withdrawals happen at a normal pace, the mathematics work. The bank typically has enough cash on hand to serve the people who visit on any given day. But when confidence wavers, the system faces challenges with it. And we do not have to go back to the Great Depression to see this occur. We observed it in 2023. Silicon Valley Bank was the 16th largest bank in the United States. $48 billion in deposits departed in a single day. $48 billion in 24 hours. The bank had been operating for 40 years. It encountered difficulties in 72 hours. First Republic Bank, over $100 billion in deposits, moved in the first quarter of 2023 alone. The bank was taken by regulators and transferred to J.P. Morgan Chase, Signature Bank. Similar situation. Customers lost confidence. They withdrew their money. The bank could not manage the withdrawals. It encountered failure. 3 banks over $500 billion in combined assets experienced difficulties in a matter of weeks. And here is the part that should capture your attention. In March of 2020, the Federal Reserve made a decision that most Americans never heard about. They eliminated the reserve requirement entirely. Prior to that, banks were required to maintain at least 10% of certain deposits in reserve. 10 cents on every dollar. Not a substantial amount, but something. The Federal Reserve reduced that requirement to 0. Banks are no longer required to maintain any minimum percentage of your deposits in reserve, none. That policy remains in effect today, right now as you are watching this video. So when I tell you, your bank operates differently with your money, I am not exaggerating. I am not being dramatic. I am describing the legal framework under which every bank in America currently operates. Layer 2. Regulatory mechanisms. Now, let me explain what occurs when a bank actually encounters difficulties. Because this is where most Americans discover a situation they did not expect. Most people have heard of assistance programs. That is what occurred in 2008 during the financial crisis. Banks made poor decisions. They lost billions. and the federal government stepped in with $700 billion of taxpayer money through the Troubled Asset Relief Program known as TARP to support them. The public was upset. The banks survived. The taxpayers covered the cost. What most Americans have not heard of is internal resolution. Internal resolution is different from external assistance. Instead of taxpayer money rescuing the bank from the outside, the bank addresses its issues from the inside using available resources. Under the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, if a systemically important financial institution is struggling, regulators at the FDIC can place it into a process called orderly liquidation. During that process, the bank has the legal authority to convert certain funds into bank equity. Let me say that again, so it is absolutely clear. The bank can take certain assets and convert them into shares of the institution. You might arrive with a checking account. You might depart with stock in a company experiencing difficulties. That is internal resolution. Now, if you think this is theoretical, if you think this has never actually occurred, let me take you to Cyprus in 2013. The Bank of Cyprus was struggling. The government and European regulators implemented internal resolution. Depositors with more than 100,000 euros had 47.5% of their funds above that threshold converted into bank equity. Nearly half of their money above the insurance limit was affected overnight. People woke up and nearly half their savings above the limit was converted into shares of a bank that nobody wanted to own. That was not ancient history. That was 13 years ago in a developed Western-aligned economy, and the legal framework that allowed it to happen exists in the United States right now under Dodd-Frank. Now here is the important detail. Deposits under $250,000 per depositor per bank per ownership category are protected by FDIC insurance. If your bank encounters difficulties and your balance is under that limit, the FDIC steps in and makes you whole, usually within a few business days. That protection is real and it is important. But anything above that $250,000 limit is classified as an unsecured claim against the bank. You are no longer a depositor at that point in the eyes of the law. You are a creditor. You are someone the bank owes money to, and creditors may experience losses in a liquidation, sometimes significant losses. If you have $300,000 in a single checking account at a single bank, $250,000 is protected. The remaining $50,000 is not. It goes into the liquidation process. And in that process, you are not first in line. You are not second. You are not even close to the front. Layer 3, the priority structure. This is the part that may concern you because when a bank encounters difficulties, there is a strict legal hierarchy that determines who receives payment first from whatever assets remain. And the American depositor has lower priority. At the very top of that hierarchy are derivative counterparties. These are Wall Street firms and institutional investors holding complex financial instruments, credit default swaps, interest rate swaps, currency derivatives, collateralized debt obligations. These counterparties have what is called super priority status under the Bankruptcy Abuse Prevention and Consumer Protection Act. They receive payment before everyone else, before bondholders, before other creditors, and before depositors. Now, let me give you a number that puts this in perspective. The 5 largest banks in the United States, J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs, and Morgan Stanley, collectively manage over $200 trillion in notional derivative contracts. $200 trillion, the entire gross domestic product of the United States, is approximately $29 trillion. The derivative exposure of just 5 banks is nearly 7 times the entire economic output of the country. In a normal environment, most of these derivatives offset each other. They are hedged. The net exposure is a fraction of the notional amount. But in a systemic crisis, when multiple counterparties struggle simultaneously, when correlations break down, when the hedges do not work as expected, the gross exposure becomes relevant, and that exposure dwarfs everything else on the balance sheet. Below derivative counterparties come secured creditors. These are lenders who hold collateral against their loans. Then come senior bondholders, then unsecured bondholders, then subordinated debt holders, and then at the bottom come uninsured depositors, regular people with bank accounts above the FDIC limit. You have lower priority. Now, let me tell you about the fund that is designed to protect you: the FDIC's Deposit Insurance Fund. This is the pool of money the FDIC uses to make depositors whole when a bank encounters difficulties. As of the most recent reporting, that fund holds approximately $128 billion. $128 billion sounds like an enormous amount of money until you compare it to what it is designed to cover. Total insured deposits in the United States exceed $10 trillion. The Deposit Insurance Fund covers approximately 1.2% of total insured deposits. 1.2%. If one mid-sized bank encounters difficulties, the fund can manage it. If 2 or 3 regional banks struggle simultaneously, the fund can probably manage it. But if we experience a systemic crisis where multiple major institutions face trouble at the same time, the FDIC would need to borrow from the Treasury Department to address the shortfall. And that borrowing is not automatic. It requires political will. It requires congressional support. It requires decisions made under extreme pressure in the middle of a crisis. I am not suggesting the FDIC will encounter difficulties. The FDIC has successfully protected insured deposits throughout its entire history since 1933, but I am noting the mathematics are tight and the cushion is smaller than most people realize. Layer 4, the recent developments. And now we arrive at what is happening right now. What prompted me to make this video? Because recently, the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency jointly released a new proposal to revise bank capital requirements under the international framework known as Basel III. Let me explain what Basel III is and why it matters to you. After the 2008 financial crisis, international regulators agreed that banks needed to maintain more capital against their risks. Capital is the cushion that absorbs losses. The more capital a bank maintains, the more losses it can absorb before it becomes insolvent. The more losses it can absorb, the less likely it is to struggle. The less likely it is to struggle, the more secure your deposits are. Basel III is the set of international standards that dictates how much capital banks must maintain. It has been debated, revised, and delayed for over a decade. In 2023, U.S. regulators proposed a version called the Basel III Endgame that would have significantly increased capital requirements for the largest banks. The proposal would have required the biggest institutions to maintain substantially more money in reserve against potential losses. The banking industry responded with an intensive lobbying campaign in recent memory. They invested hundreds of millions of dollars. They argued the rules would restrict lending. They said it would affect consumers. They said it would slow economic growth. They contacted lawmakers. They submitted numerous objections during the comment period. And they were effective. The new proposal released recently does not increase capital requirements. It modifies them differently. The largest banks, the globally systemically important banks, will see a 2.4% change in required capital. Large regional banks receive a 3% adjustment. Smaller banks under $100 billion in assets receive nearly 8% capital relief. Let me translate that into plain English. During a period of significant global changes, with oil prices experiencing volatility, with shipping routes facing disruptions, with global stock markets experiencing challenging periods, with the United States actively engaged in various international situations, regulators recently told the biggest banks in America that they can maintain different levels of capital against potential losses. The comment period for this proposed rule is typically open for public input. That is usually a 90-day public comment window. You can visit regulations.gov and submit your perspective. Tell the regulators what you think about adjusting bank capital requirements during a period of extraordinary global changes. Your comment becomes part of the public record. The regulators are legally required to consider it. Now, let me shift from the considerations to the approaches, because understanding the situation is only useful if you know what to do about it. Here are the 3 approaches I am taking right now with my own money. Move 1. Understand your FDIC limits and utilize every dollar of coverage available to you. FDIC insurance covers $250,000 per depositor, per insured bank, per ownership category. Most people hear $250,000 and think that is the maximum they can protect at a single bank. That is incorrect. The key phrase is per ownership category. Here are the ownership categories recognized by the FDIC: single accounts, joint accounts, revocable trust accounts, irrevocable trust accounts, certain retirement accounts, employee benefit plan accounts, corporation, partnership, and unincorporated association accounts and government accounts. Each of these categories receives its own $250,000 of coverage at the same bank. Let me show you what this means in practice. Say you are married. You have an individual checking account that is covered up to $250,000. Your spouse has an individual checking account that is another $250,000. You have a joint account together that is $250,000 per co-owner, so $500,000 total for the joint account. You have a revocable trust account naming your spouse as beneficiary. That is another $250,000. Your spouse has a revocable trust account naming you as beneficiary. Another $250,000. That is $1.75 million in FDIC coverage at a single bank for one married couple, without opening an account at a second institution. If you add payable on death designations with multiple beneficiaries, the coverage expands even further. Each unique beneficiary in a revocable trust or POD account adds another $250,000 in coverage. Visit the FDIC website at fdic.gov and use their electronic deposit insurance estimator. It is free. You enter your account types, your beneficiaries, and your balances, and it calculates your exact coverage. Do this today, not next week. Today. If after structuring your accounts, you still have money above the FDIC limits, move the excess to a different FDIC-insured institution. The coverage resets at each separate bank. You can distribute your deposits across 3 or 4 banks and have every dollar fully insured. There is no limit to how many banks you can utilize. Move to diversify beyond the banking system entirely. This is the approach that most financial advisors rarely discuss because it does not generate commissions for them. United States Treasury securities, Treasury bills, Treasury notes, and Treasury bonds are backed by the full faith and credit of the United States government. They are not held at a bank. They are not subject to internal resolution provisions. They are not part of a fractional reserve system. They are direct obligations of the federal government. You can purchase Treasury securities directly through treasurydirect.gov. No broker, no middleman, no fees, no commissions. You set up an account, link it to your bank, and purchase Treasury securities directly from the United States government. Short-term Treasury bills, those maturing in 4 weeks to 1 year, are currently yielding competitive rates. That is comparable with or better than what most savings accounts and certificates of deposit are paying. And your money is not sitting on a bank's balance sheet. It is not being lent out. It is not at risk in internal resolution. It is backed by the taxing power of the United States government. For retirees, Treasury securities serve another important function. They are exempt from state and local income taxes. If you live in a state with high income taxes, the after-tax yield on a Treasury bill can be significantly higher than the after-tax yield on a bank CD paying the same rate. I am not suggesting you remove all your money from banks. You need a checking account for daily transactions. You need liquidity for emergencies. But the portion of your savings that you are not using day to day, the portion that is sitting in a savings account earning minimal returns, consider whether that money would be better protected and better compensated in Treasury securities. Move 3. Conduct a comprehensive review of every account you own. This is the step that requires the most effort but provides the most clarity. Examine every financial account you have, every checking account, every savings account, every certificate of deposit, every money market account, every brokerage account, every retirement account, every annuity, every life insurance policy with cash value, everything. For each account, answer these questions. What institution manages this money? How much is in the account? What type of insurance protects it? Am I within the coverage limits? And who is listed as the beneficiary? Let me explain why each of those questions matters. What institution manages the money? You need to know whether your bank is FDIC insured. Most are, but not all. Credit unions are insured by the National Credit Union Administration, the NCUA, not the FDIC. The coverage limit is the same, $250,000, but the insuring entity is different. Make sure you know which one applies to each of your accounts. How much is in the account? You would be surprised how many people do not know their exact balances. Interest accumulates, dividends get reinvested, balances increase over time. An account you opened with $100,000 5 years ago might now hold $260,000. $10,000 of that exceeds insurance limits, and you might not even know it. What type of insurance protects it? Bank accounts receive FDIC coverage. Credit union accounts receive NCUA coverage. Brokerage accounts receive SIPC protection, which is different from both. SIPC covers up to $500,000 in securities and $250,000 in cash if your brokerage firm encounters difficulties. But SIPC does not protect against investment losses. If your stocks decline 50%, SIPC does not help. It only helps if the brokerage firm itself experiences problems and your assets are missing. Am I within the coverage limits? This is the calculation you need to perform for every single institution. Add up all your accounts at each bank by ownership category and compare the total to the FDIC limit. Do the same for credit unions with NCUA limits. Do the same for brokerages with SIPC limits. Who is the beneficiary? This matters for FDIC coverage because beneficiary designations can create additional ownership categories. A payable on death account with 3 named beneficiaries receives $750,000 in coverage at a single bank, $250,000 per beneficiary. If you have not reviewed your beneficiary designations in the last few years, do it now. Life changes. People get married, people get divorced, people pass away. If a named beneficiary is no longer living, that coverage category may no longer apply. Let me give you one more piece of information that most people do not know. If you have a retirement account at a bank, a traditional IRA or Roth IRA held in a bank CD, for example, that account receives its own $250,000 in FDIC coverage, separate from your other accounts at that same bank. But if you have the same retirement account at a brokerage, it falls under SIPC coverage, not FDIC. The type of institution matters as much as the type of account. Here is the summary. The banking system is not designed to protect you. It is designed to function. And it functions well when everything is stable, when confidence is high, when markets are calm, when the global economy is predictable. We are not in that environment right now. Oil is experiencing price volatility. Shipping routes face various disruptions. Global shipping encounters challenges. Stock markets around the world are experiencing difficulties. The United States is engaged in various international situations. And during all of this, regulators recently told the biggest banks in America that they can maintain different levels of capital against their risks. I am not suggesting you become alarmed. Alarm is never a financial strategy. I am suggesting you pay attention. I am suggesting you understand where your money is, how it is protected, and what happens to it if something unexpected occurs because the rules have evolved. The reserve requirements have changed. The capital requirements recently received adjustments. The internal resolution framework exists in law, and the FDIC insurance fund covers 1.2% of what it is designed to protect. Knowledge is the only asset that cannot be affected in internal resolution. It cannot be devalued in a crisis. It cannot be lost in a bank situation. And right now, the most valuable thing you can do with the next 30 minutes of your life is review your accounts, check your FDIC coverage, and make sure every dollar you have worked your entire life for is appropriately protected. If this video helped you understand something about your money that you did not know before, subscribe to this channel. I break down the financial approaches that actually matter, the ones that protect your family and your future, not the ones that make Wall Street wealthier. Share this video with someone you care about because the banks are not going to inform them. The regulators are not going to inform them. And by the time the news covers it, it may already be too late to act. I will see you in the next